Hey everybody, welcome. This is Tom Schmidt from Ticker Tape Investments, and super excited to be doing this presentation yet again. I've done it in a lot of different states in person, and of course many times online. Those of you who know me know that one of my favorite things is helping people learn about investments. I always tell the story that my father worked on Wall Street his whole career, and when I was a little bitty kid, when Dad would come home from work, I'd go running up to him and say, "Daddy, did you make any money today?" And he would reach in his pocket and pull out whatever change he had and hand it to me. It'd be like 37 cents. He'd be like, "Yes, Dad, I did, Tommy," And so from one of my earliest memories is understanding that in the stock market, some days you make money and some days you don't. And a lot of my behavior in the investment arena comes from stuff I learned not only from my father, but also from many of his friends and partners and bosses and associates that he introduced me to over the years. And I consider myself very fortunate to have had access to that sort of insider information. And so I do as much as I can to try to share that with those of you that invest with us. So without further ado, standard disclaimer, we don't offer legal, professional, or investment advice. All of this information is being provided in a summary fashion, and there's no solicitation here for anybody to make any investment. This is just for educational and entertainment purposes only. I do, for those of you who are new to Ticker Tape, and I know there's quite a few folks on right now that I'm not familiar with, so I assume you're new to Ticker Tape. We'll tell you a little bit about who we are and what we do. I'm the one that started all this. I've been a lawyer for, I guess, 28 years now, and an entrepreneur for 24 years now, and recently co-founded my 17th venture. And about 12 years ago or so, I became an active private equity investor after began generating returns in my entrepreneurial activities. I very quickly realized that I did not have enough capital to deploy across a diversified private portfolio, that I needed to make smaller investments. And so with some clients of mine, we started Ticker Tape Investments. And it started as two venture capital funds, you would call them. We call them member managed private equity funds. They were creatively named Ticker Tape Investments and Ticker Tape 2. The idea behind these funds is that we don't pay management fees. We are going to pool our capital, invest in a portfolio of typically early stage investments, and then share the work, share the deal flow, evaluating the deals, managing the investments, pool our capital, and then split the profits. Ticker Tape 1 remains closed to new investors, but Ticker Tape 2 is still open. If you're interested in hearing more about that, reach out to us. The idea is that everyday professionals and entrepreneurs can get access to more deals, experts from different industries. We've got guys in Ticker Tape from literally every industry you can think of: oil and gas, transportation, technology, medicine, about 10 different variations on medicine, from pharmaceuticals to real estate to high-tech equipment to healthcare to billing and Medicare expertise and such, and of course a larger pool of capital. Which, again, everything we're going to talk about when I talk about what we do at Ticker Tape, it's all for my own benefit, right? I'm not doing this to pool capital to do it as a favor for you. I'm doing it to pool capital to give myself more opportunities to invest in more investments. And so you'll hear that theme sort of throughout not only today's presentation, but also other presentations that I do. The other thing that Ticker Tape has done is create a series of what we call single purpose entities. So we go out and find an asset that we want to invest in. It could be shares of a privately held company, or it could be that picture in the top right, which you can't really see very well, is a hotel that we invested in South Beach in Miami. Or it could be a blockchain company. We buy the asset, we then create an LLC to own it, and we offer to our partners the opportunity to participate in that investment. So for instance, we went out and bought shares of a company called ThoughtSpot, created an LLC. I think it's called TTI Thought Holdings LLC, and investors, some of whom are on this call, purchased shares in that LLC. We then hold the shares of ThoughtSpot until it sells or goes public. If it becomes publicly traded, we then distribute the shares to investors. Each of these companies you can see on the screen, Tom Schmidt, I personally put my own cash into each one of those deals and a bunch more. How many are on here? 8, 9, 10, 11, 12. There's 12 icons on the screen there. I think we've done something like just under 30, like 28 separate partnerships, plus a handful of apartment complexes, a handful of hotels, emergency rooms, surgery centers, et cetera. And so guess what? Tom Schmidt has a very diversified portfolio of private investments and pre-IPO investments because I've put a little bit of money in each of those deals. I could have taken the same amount of money and put it in one deal, but I put it, sometimes $10,000, well, actually, sometimes $2,000 a time. I think my total cash investment in the Ripple deal was $2,000. Typically, I'm putting 25 grand in each one. That's kind of my baseline number that I start from, and then I say, oh, I want to put less in this one, so I'll go down from 25, or I want to go up and put more in this one, like a SpaceX, where I'm invested in, I think, 4 different SpaceX funds and a much larger investment. Currently, we have 4 SPEs that are open. TTI Solar, that is investing in rooftop solar installation companies, EPC companies. TTI Gaming, which is investing in blockchain gaming software companies, where these are video games that people play and they earn cryptocurrency. They earn a living basically by playing the video games. And of course, along with that, we have crypto investments in and NFTs alongside the gaming software company. TTI Debt is a great fund if you're looking for long-term income. It pays quarterly dividends from its debt investments. And then TTI Metaverse is also, that's an ongoing managed fund that is not a single purpose entity. It invests in multiple different transactions, cryptocurrency, NFTs, blockchain software companies, and as the name suggests, actual virtual real estate in the metaverse. Over time, we've had multiple investments. You may hear me talk about some of these examples in a minute because they are good lessons for us. Everything from SoFi to Palantir to a surgery center investment to obviously TTI Debt. It's kind of a revolving fund where we make a loan, it gets paid back, make another loan, et cetera. And so it revolves. All right, to the substance of why you guys came. The top 5 mistakes investors make. I love talking about this stuff. Of course, I'm pretty sure that at some point in my life, I've made all of these mistakes to some degree or another, sometimes big time, sometimes just a little bit. But we'll go through them and try to help you guys avoid some of the mistakes that most investors are literally making on a daily basis. Number 1, failing to conduct adequate due diligence. And you could almost get rid of all the other 4 things. If you just fixed this one, you would do a lot better in your investment performance. Number 2, not being diversified. That word diversified is sometimes a little oversimplified when you see it on TV or hear about it in investment context. We're going to dive into that a little bit and talk about in detail what that means and what you need to do that most people are absolutely not doing with their portfolios. Number 3, not taking advantage of private deals. Now, my father would have told you, my father passed away, by the way, but back in the 1980s or 90s, he would have told you that this was one of the top 5 mistakes that investors make, is not diversifying into private market deals. It is probably 50 times more important today. It's also a lot easier, but companies are going public later in their cycle. And so it's very important that you invest in some private companies alongside your publicly traded portfolio. Number 4, not having a long-term strategy. This is pretty obvious. A lot of people just behave like in the moment. What's happening today? Let me adjust my portfolio to take advantage. And you need a longer term strategy. And then last is ignoring the impact of fees and expenses. And I have some interesting takes on that. Let's talk about number 1. Obviously, the most important one, failing to conduct adequate due diligence. So maybe that line is written by the lawyer in me, because one of the things we do as lawyers when we look at deals of any kind is what we call due diligence and checking all the boxes. And the way that works, and if you're watching CNBC and you hear that 2 companies are going to merge, and they may even tell you that XYZ law firm is handling the transaction on behalf of the acquiring company. I guarantee you those lawyers, no matter how much they charge and how experienced they are, they have a due diligence list. And it is literally a bullet point list of typically hundreds of items that they will go through before they let the transaction go through. And you guys as investors should aspire, you can't always achieve that, but you should aspire to that sort of level of effort to evaluate every investment you make. And I'm talking about if you want to buy some shares of NVIDIA next week, or if you want to buy Freeport McMoran because you think copper prices are going to go up, or you want to buy a gold ETF because you think the price of gold has pulled back a little bit, but it's going to keep going on its run. Any of those things, don't just do it. You got to make an investigation. One of the things that I'm happy about Jim Cramer about is he's brought this to the forefront. But of course, guys like Peter Lynch from Fidelity and Warren Buffett and all those guys have all been preaching for years. Make sure you do your due diligence. And for Tom Schmidt, this is really about privately held deals, because that's really what I do. I've learned that I can make so much more money in private investments that I focus on that rather than publicly traded stocks. Although, of course, I have a 401k and all that good stuff too. But even with privately held companies, Jim Cramer would say, do your research, understand the company. Who's the management team? What's their track record? What is the mood of existing investors? And again, these questions are equally important with a privately held company and a publicly traded company. If you're looking at investing in a private company that has other shareholders, man, you should be talking to those shareholders, right? Hey guys, what do y'all think about this company? What do you think about the management team? We had a interesting thing happen. Y'all, I'm sure all you know that Utility Rescue is raising capital right now. We had an investor we did a call with a week or so ago, and we got on the Zoom call, and the guy had a list of questions, and he was literally reading off the list, and I immediately recognized that he had pulled like a list off of the internet. I don't know if it was ChatGPT or he just Googled it or whatever. And interestingly, one of his questions was, have any management team members recently left the company? And of course, my immediate reaction was, no, they haven't. We're pretty stable, blah, blah, blah. But after the call, I was thinking about the fact that, let's see, this is June of 24. So in 22, we had a manager, a vice president who left the company. We had to terminate him because he had some personal stuff going on in his personal life. And it was of significant harm to the business. In hindsight, in particular, it kind of derailed some of our growth in our sales program. And at the time, if we weren't raising capital at the time, but if we had been, and someone asked that question, we have to say, yes, he did leave, and yes, that is significant to the company. And so it's a very good question to ask. And I was like, well, yeah, he got it off a little form, but goodness gracious, there are lots of instances where that's a really good question to ask before you invest in a business. Another big one, and I don't know if in the course of my career, I'm not sure this has really been a big deal, but it now is a lot more significant. What does the operating agreement or the bylaws say? And you've seen in the public markets, there's a lot more conversation about corporate governance and how does it work, right? There's this big thing, if y'all haven't read about it, you know that ChatGPT is owned by something called OpenAI, which is technically a nonprofit company. And it was created to be a nonprofit, but now has been invested in by Microsoft, and there's this drive to create revenue and stuff. And so the question is, what the management team that controls the bank accounts, what obligation do they have with that money? Do they have an obligation to pay dividends to shareholders, or are they supposed to make the company truly a nonprofit and sort of invest it for the good of humanity? And so that sort of thing matters, right? You need to know what happens with the corporate structure? Who's going to get paid first? What happens if dividends are declared? Can management team just pay it out to themselves in bonuses? What is the corporate governance of the company? The next one is one of my all-time favorites. One of my mentors taught me this was, will the dogs eat the dog food? Now, of course, this is a question for an early stage company. We actually had another conference call with a potential investor recently who was telling me that he's looking at a lot of very early stage deals. He gave me some examples, and I said, wait a minute. I said, listen, you can do what you want. Tom Schmidt, I will not invest in a company if we don't know whether the dogs will eat the dog food. Because I can make the world's best dog food. I can tell you how it's healthy. It's going to make your dog live a lot longer. His hair won't fall out. His coat will be shiny. He'll have energy level, all that stuff. But if the dog doesn't like the food, I'm going out of business, right? Dogs in general, not just one dog, but lots of dogs have to like the dog food. Another one of my great examples I've used is had a guy come to me and he's like, Tom, we've got this miracle bacteria that you can take a fistful of this bacteria, it's like in a powder form, and put it in a barrel of water, of oily, polluted water, and it will clean the water such that it can then be dumped into a public reservoir or a river or wherever. And I didn't go see it in person, but they showed me a video and they showed it working, and they showed this permit where they'd gotten a permit to let the water be disposed. Well, I had a client at the time that was in the wastewater cleaning business, so I called him immediately. I'm like, oh my God, we got to go buy this company. It's going to make you a billionaire. And it literally on a phone call, he goes, it doesn't work. I said, oh wait, you know these guys? I said, how do you know them? It's a blah, blah, blah company. He goes, no, I've never heard of them. I'm like, what are you talking about? I go, how do you know it doesn't work? He goes, Tom, he goes, I promise you it doesn't work, because I've seen 20 of these deals. He said, the thing is that if you take a gallon of water and a fistful of the bacteria, it will clean the water. The problem is that the ratio between the volume of water and the amount of bacteria you need is not a straight line. If you had like a container, actual shipping container volume of water, you would need like 6 dump trucks of the bacteria to clean that much water. I was like, oh my gosh. And sure enough, the company failed. It was all a sham. And so at the end of the day, if you don't know if the product isn't out there selling, if people aren't buying it, if it's not performing, it's probably too risky for a reasonable investor to invest at this time. Now, having said that, it's risk return profile stuff, right? So nothing wrong with investing early, having a huge upside in your investment return to take advantage of something early. But for me personally, I've learned over time it's better to invest after we know that the dogs will eat the dog food. Another thing to look at is regulatory concerns. And to be honest with you, I probably would not have wasted y'all's time with this in a presentation like this. And I don't think it's ever made the list before. The reason it's on here is because now there are so many crypto related deals where companies get derailed because they can't qualify for some sort of participation in the United States, or the exchange blocks their transactions, or they have some sort of securities problem. Now, of course, there's also a lot of environmental regulation going on. Make sure you're familiar with the regulatory concerns that govern the investment opportunity. This goes beyond investments, but it's very popular now for these trading algorithms for, hey, we'll teach you how to trade commodities or currency futures, or we trade commodities and our software knows how to do it. All kinds of securities regulation problems with those sort of companies but also they tend to be scams. And so I caution you, anytime you're looking at something like that that involves securities or cryptocurrency or anything environmental sort of outside, make sure you do some research on what are the regulatory concerns that could affect the company. Lawsuits, big thing, especially for privately held companies. It's one, if you're a privately held company, you're not publicly traded, typically there's very little information kind of out there about you. And so one of the places you can find public records is in lawsuits filed against the company. I would always Google the name of the company, the names of the key founders, and the word lawsuit or sued before I invest in a private company. News and other social media commentary. Do research, find out what people are saying about the company. That's a big thing. Valuation is the most important thing, right? It's not, I talk about this all the time with regard to Apple. I'm in a little investing club group, and there was a big debate recently because we have a big profit in our Apple position, and everybody was saying, should we sell it or should we not? And my 2 cents was, listen, man, one of the greatest companies of all time, if not the greatest company. Today in 2024, it's probably overvalued. And so the question of, is it a good company, is not the question you should be asking when you go to invest in it. It's what is its valuation? And of course, what is its valuation relative to its peers, right? I saw a guy on TV years ago came on CNBC and said, you know, his investing idea was go look at Home Depot and Lowe's and decide which company you think is going to outperform the other, and you can buy one and short the other, and you can do it with options or however you want to do it. But you know, you don't have to be right about whether their stock is going to go up or down. All you have to be right about is which one is going to do better. So that kind of idea, like how does the company you're looking at compare to its peers? Is it a favorable comparison, particularly as to valuation? Again, doesn't have to be the better company, right? I'm not going to do this, and I'm not saying this, but hypothetically, you could look at 2 companies like, let's say, NVIDIA and ARM, and you could say, well, listen, I know NVIDIA is the better company. Their chips are going to, you know, dominate the market for years to come, but I'm going to actually choose to invest in ARM because it's dramatically undervalued compared to NVIDIA. And so that's the kind of analysis I want you guys to be making anytime you consider any investment. What's the valuation? What's it look like? And my last one is, this is the way it was taught to me. It may not be the right way to say it. Does management have skin in the game? And this is 100% a factor for me with privately held companies. I can't tell you how many times I've looked at deals and I was told, oh, well, you know, the management team is you know, betting on the company too because we're taking reduced salaries. And anytime I hear that, I'm like, okay, now I got to be skeptical, because if you're earning a salary from a company that isn't profitable, we got issues, right? And yes, I get it. You know, you could leave and go get a job and make $200,000 a year, and you're only paying yourself $100 here, and you're getting stock for the other 100. And I'm not going to tell you that I don't pay attention to that. It's not that I disregard it, but I'm much more interested in 2 things. Number one is, did the person invest cash in the company? How much of their own cash do they have in the deal? If you ever watch Shark Tank, you know, those sharks, and particularly Mark Cuban, it's always a question he asks: how much have you invested out of your pocket in the deal? That's a big factor for me. And the example that you may have heard me use before, one time I'm just clicking through the channels a long time ago, obviously, and Jimmy Carter was on, and they asked him, they said, you know, what is the difference between the United States and the Soviet Union? Back then it was the Soviet Union. And Carter's flippant response was, well, a farmer in the Soviet Union will not stay up all night with the state's pig. And they're like, what are you talking about? And he goes, well, he said, if you're a farmer in the Soviet Union and your pig dies, it gets sick and it dies, the next day or maybe a couple of days later, the government comes and brings you a new pig. He said, if you're a farmer in Iowa and your pig dies, your daughter may not get a new pair of shoes next week, because you have to go replace the pig on your own. So a farmer in a capitalist society, his point was, will literally stay up all night nursing a sick pig back to health, whereas the farmer in the Soviet Union goes, die, I don't care. I'm going to sleep, or I'm going to go out and party because I don't care. The new pig will show up the next day. And so to me, when I'm going to trust my money with you, I'm going to trust you to run the business using my money. I want to make sure that my interest is aligned with yours. And we're going to talk about that a lot more in a minute. I want to be in the same position you are, number one. Number two, if the company fails or underperforms, I want you to feel pain. And losing your job and going back to the job you left is not enough, right? Preferably, I want you financially devastated. I want the founders, if I'm investing in an early stage deal, I would prefer that the founders have to file bankruptcy personally if the company goes bankrupt. That tells me that they're going to be highly, highly motivated to do whatever it takes to make the thing work. And so that's a big factor with me on a privately held company, but it is also big for publicly traded companies, right? What is management doing? Are they selling their shares that they were granted? You've seen the insider selling reports and these kinds of things. That is actually a factor, because anytime a member of the management team makes a decision to buy or sell the company's stock, they are making an analysis of what is the likely result of the company. Is the stock price really high? Man, I'm going to take some of my shares, take my money off the table while the getting's good. That is not a good sign for those of us that have no say in the operation of the business. A big factor that I look at. The second mistake is not being diversified, and I always put on there enough, because many of you are probably quote unquote diversified, but I'll promise you, you are not diversified enough. You may watch on Mad Money on CNBC, Kramer does his little "Am I diversified" thing, and the caller gives 5 stocks and he tells them if they're diversified. I just want to crawl under the table in the fetal position. I get so upset by this segment, and I pat him on the back, because at least he's brought the word diversified into the common investor vernacular. But he's just so wrong about what is diversified. So what you'll see if you Google, how do I get a diversified portfolio, is they'll tell you things like, well, you got to buy a large cap fund, a mid cap fund, and a small cap fund. And that just does not do it. First of all, yes, you need to have multiple asset classes in your portfolio. But that's not enough. That little pie chart, what are there, 6 pieces there? Again, not nearly enough. But if you had 6 asset classes in roughly those proportions, you're not diversified enough. What you need to do is go to each pie piece, and within that pie piece, make sure you are diversified. What do I mean by that? If you go out and Google, and I probably should have looked up these statistics and shown them to you. The problem is they change over time, so it's hard for me to sometimes keep up. But you can Google things like what percentage of mutual funds own Apple stock, and it is ridiculously high. And you can also look at statistics like most widely held stocks. And what you'll find is that your mid-cap value fund has Apple in it, because some guy made an argument that it barely fit within their fund profile, and you thought you only owned it in your big cap growth fund, but in fact it's in all your big cap funds, including your total stock market fund. It's also in a couple of your mid cap funds. It's in your tech fund. It's in your consumer products fund. And so you own way too much Apple stock. And so it's not enough to say, oh, I'm in 5 different asset classes. If you're owning the same investments, and it doesn't even have to be all just Apple. If it's all Home Depot and Lowe's and Walmart and Best Buy, they sound like those are diversified, but those are all big box retail stores. And so they're all going to go up and down with the same economic impact, and you're not going to be diversified. So certainly as a baseline rule, investing in mutual funds is the best way to diversify. But anytime you look at a mutual fund, you can look at what are the top 10 holdings of the fund, and you're going to find out that they tend to be the same stocks. Why? Because investment managers who make those decisions keep their jobs based on outperforming their competitors. And how do you do that? You buy the stocks that keep going up, the Apples, the Metas, the Amazons, the Googles, the Microsofts, the Nvidias this month. And so they all, they're like lemmings is the saying that they'll use on CNBC. They just follow each other. And if they're following each other with your money, that's not good, right? And so make sure you're going way beyond, like, yes, you need some large cap publicly traded stocks, but make sure within that category, you're diversified. You're not just buying 3 large cap funds that are owning all basically the same stocks, or maybe they're not the same stocks. Like I say, maybe one owns Home Depot, the other one owns Lowe's, or one owns Target and one owns Walmart. That's not diversification. Make sure that you're diversifying within each of the categories. Which brings us to rule number 1. I'm going to give you all a handful of rules tonight. One of them is don't put it all in one deal. And this is a mistake that, of course, I've made many times, where the easy road is when you have a block of money that you need to invest, is it's easy to go find one deal or 2 deals and you're done, right? You don't have to go read 37 different financial statements to invest in 37 different companies. You can just do 1 or 2. Resist that urge. Try to diversify as much as you can. One of the things I've done over time is I'll look at my portfolio and go, you know what, I got too much in this one. So I say, you make up a number. I got $75,000 one way or another invested in Tesla. And I go, well, 25,000 of it is in the ARK fund, and I don't want to sell that because I like Kathy and I want to have some money in her management. So I'm going to sell half of my options position maybe in Tesla, and then I got to go find something else to buy to get that diversification. That situation, I've done that just kind of generally speaking when I kind of look and evaluate my portfolio. It's also happened like if something runs up real big, maybe Tesla is the best example of that, where, oh my gosh, it just had a stock split and my positions all kind of doubled. Well, now I've got too much in that. Let me sell part of it and put it in. So go find something else to put it in. In this category, where I observe others make the biggest mistakes is they invest in one deal. They have $1 million that just came in because they sold their multifamily investment, liquidated or whatever, and they're like, okay, I now have this task weighing over my head. I've got to figure out what to do with my $1 million. Oh, well, this opportunity came along. Let me just put it in that. And maybe they do the due diligence. Maybe they do the work associated with that one investment. But what they should be doing is making $20,000, $50,000 investments, not $1 million investment. So rule number 1, try to think about this and remember it. Don't put it all in one deal. Find ways to make more smaller bets. Now this is the story of ticker tape, right? This is why Tom Schmidt created ticker tape. It allows me personally to make more smaller bets. I don't have to meet all the minimums of all the different deals, right? There's a minimum 1.5 million, I think it was, one of the SpaceX investments we made. Well, I was never going to put $1.5 million of my own money in one deal, so I had to get other investors to come along with me. We pooled our cash, and I think in that one, don't quote me, I think I put 100 grand in that particular round, and we ended up putting in more than 1.5 million because we had a bunch of folks join us. So, but that notion, being able to find smaller opportunities, allowed me to make more bets and have a very diversified portfolio. One of my other mentors, different mentor, once told me if 3 out of 4 deals are going to fail, you better invest in all 4 deals, because trying to guess which one's going to make it and which one isn't is not something you're likely to be successful at for the long run. And if you're investing particularly in early stage transactions, like for instance, the 2 ticker tape funds invest in early stage deals, We've already had a couple be successful. We've already had a couple fail. And so we're kind of waiting for the middle ones to hash out. But if we had tried to pick, maybe we would have only picked the ones that failed. So again, this goes back to the being diversified, number one. It also goes back to make more smaller bets. Because if you make one bet and it gets you 10 times your money, it's going to cover 10 other bet or 9 other bets, right? And so if you kind of do your due diligence and you make lots of smaller bets, your chances of getting a significant return profile on your investments, it goes up dramatically. And again, I'm going to highlight this again. I said it earlier. It's not just, don't think you've checked the 6 boxes and you've got commodities and you've got large caps and mid caps and small caps and international. And, now, of course, you got to have crypto also. If you don't have any crypto investments, call Rita. We'll get you some options on that and give you some advice on what to do there. But it's now an asset class that is not correlated to the stock market. And so you got to make sure you're in that. You got to have some bonds. I didn't even mention bonds. You got to have some more conservative investments. You need some privately held investments, but don't just check those boxes and say, I'm done. You have to be diversified within each one of those categories. Number 3, not investing in private deals. I don't think the guys on this call typically are going to have this problem, but if you haven't gotten the memo already, you gotta invest in private equity, venture capital, early stage, late stage, and particularly pre-IPO, because the world has kind of changed. And private equity has definitely been outperforming the overall stock market, even with higher fees. And we're going to talk about fees in a minute. Rule number 2 today, private deals tend to generate better returns. Make sure you put some money in private deals. Again, you can't just do it willy-nilly. You got to do some due diligence. It takes maybe a little more work, but I should say it's harder to get the information maybe because it's not publicly available, but it's worth it because over time, those types of investments are going to give you a better return. And I want to make very clear, what I just said is true in a vacuum. Over time, if you invest consistently in private deals, you're going to make more money than if you invest consistently in public deals. That is even more true now because of things like the Jobs Act, Sarbanes-Oxley, and then what happened with the Facebook and Google IPOs, where Google said, wait a minute, I'm not giving all this money to the Wall Street banks. Yes, we need a bank to underwrite our offering, but there's no real risk here. No one's going to lose out in the Google IPO. And so they made their opening price be on an auction basis. So what did that do? That took all the money away from the new IPO investors. Now, let's not kid ourselves. In every IPO you've ever seen, the majority of the quote IPO investors are big Wall Street banks who command control of the offering, and they get to invest first. And then of course they pass some of that, but not all of it, to their biggest customers. What does that do? Well, that rod, if all you do is invest in public stocks, you're coming in after the founders, after the venture capitalists, after the growth capital private equity guys. All those people have made their money. Then you're coming in after the pre-IPO investors. Then you're coming in after the IPO investors and the banks that underwrite the offering. And now you're buying the stock at that point. By that time, the money's already been made. It's already been made. And so this is a big reason why every investor needs to have a significant portion of their portfolio in private equity. It is a critical component in today's markets, in today's world. It's important that you have a piece of your investments in that space. Rule number 3, pre-IPO investing has become a critical piece of your investment portfolio. Let me say that again. Pre-IPO investing has become a critical piece of your investment portfolio. I did not catch on to this until I think it was 2018. And what snuck up on us is that the world changed, is the short story. The long story is that because of those things, the Jobs Act, Sarbanes-Oxley, and what happened with Facebook and Google, and well, all those things caused private equity funds to have more capital to invest in companies that were billion-dollar companies that were privately held. Therefore, those companies did not have to go public. The founders of companies like Impossible Foods and ThoughtSpot and Indigo Agriculture and Automation Anywhere, they all said to themselves, look, I don't want to go public because I can capture more of the value for myself if I can wait longer before we go public. For a while, that was a difficult thing to accomplish because the early stage investors and the employees who'd been given stock had no way to get liquidity. So what's now happened is these markets have opened up where you can actually buy shares of these companies that you couldn't buy before while they're private. And so that's what Ticker Tape has done. We've obviously done, I think, close to 30 of these things. And we'll continue to do them because of being able to capture the difference between the value of a company when it's private and the value of the company once it goes public. So this is a big piece of what Ticker Tape does. Happy to share all of our plans with us. You can do it on your own. We don't have anything proprietary with it. I do encourage all of you to make sure that you're investing in multiple pre-IPO opportunities. And it used to be very difficult. It's now a lot easier to get access to these kinds of deals. Number four, the fourth mistake most investors make is not having a long-term investment strategy. Early in my professional career, I happened to run into a couple people who said something to me like, you know, I own these shares in Exxon that I inherited from my great-grandmother. And oh, it wasn't Exxon back then. It was started as Standard Oil. And at the time, it didn't, I thought, well, that's pretty cool, but it didn't change how I thought about investing. Now that I'm in my mid 50s and my kids are about to leave high school, I start thinking in terms of what can I invest in today that I can hand to them? In other words, I'm not investing because I'm going to get a return next year, or I'm going to get a quarterly dividend, or I'm going to sell it in the short term. You got to have a long-term strategy. Now, part of the long-term strategy can be short-term deals, right? Hey, I'm going to invest. Like, I'll give you a great example from my own personal experience. So there's a multifamily property that I invested in. I think a couple of you guys on the call are actually part of it as well. And my idea personally, and of course, everybody has their own different take on the deal. But personally, what I want is I want them to refinance the property here very soon and give me back my money. In other words, cash out my original investment and then pay me dividends for the rest of eternity. And for the love of Pete, do not sell the complex, because that's what the operators want to do, right? They want to refinance, get our capital out, give us a nice return, hold it for another few years, maybe make some improvements, and then sell it. Well, to me, I'd rather get my money out, go invest in something else, and then hand my kids that investment in that apartment complex in Illinois. And so that's how I'm starting to think more and more about different investments. How can I take my capital, use it to acquire something? It goes up in value maybe in the short term, or maybe I get a partial distribution or something. I can take and redeploy that capital, but hang on to that underlying investment for the long run. Which brings us to number four, rule number four: do not try to time the market or an investment. There are exceptions to that, but things like today, 2024, is a good time to be looking at investing in artificial intelligence. Obviously, if you haven't heard about that, you haven't been paying attention. But that's not timing the market. That is investing in a new industry that has significant potential growth over the next 25, 35, 50 years. So think in terms of somebody threw it in my face recently, and to be honest, I hadn't thought about it in this context. The whole notion of the gold mining deal, that if you guys don't know what companies still exist today that started in the 1849 gold rush in California, And I'll give you a clue, none of them are gold or gold mining companies. One of them is Levi Strauss, because they sold overalls to the miners that were all frantic and excited about mining. And the other one is Wells Fargo, which number one was obviously the Pony Express communication channel, but also the bank where you put your money when you found gold. And so those infrastructure companies for AI is certainly a place. Number one, you want to be putting money, but number two, you want to be putting money for the long term, not trading the stock or buying options or whatever those sorts of things are. So don't try to time the market, except what my example is, don't try to time a wave, try to time the tide. Don't try to time the waves, try to time the tide. So for instance, if the stock market as a whole collapses because of COVID, and you can look around and go, you know what, the US is not going to fail. I made a lot of money making big risky bets on the US stock market in mid 2020, 7 figures in fact. I was not timing a little wave, I was timing a massive tide. The tide went out, I bought a bunch of stuff, the tide came in and I sold it. But it was about a year to a year and a half. It wasn't like a quick deal, hey, let's get in, let's get out. I saw it as a big time trend. Artificial intelligence would be another example. Don't try to time, quick trading, but maybe make some investments in this big trend that's coming. Of course, you've all heard invest consistently over time. Make sure you're putting the maximum amount you can in your 401k or your IRA. If you don't have one, go out and get one. And contribute the maximum every year to those over time. That makes the biggest difference you can for your net worth and for the financial viability of your children and grandchildren. Don't ever overreact to volatility. I love that example. I think it's a Mark Twain example of the cat on a stove. He said, if a cat ever sits on a hot burner, it'll never sit on a hot burner again, but it will also never sit on a cold burner either. And so don't make the mistake of, hey, I got burned, I'm never going to do that again. Don't react emotionally or overreact to volatility. I remember my grandmother refused her whole life to put money in the stock market, despite the fact that her son-in-law was, traded on Wall Street and told her, look, we'll make conservative investments. But she got burned, or watched people get burned, I guess, during the Great Depression. And so in her mind, the stock market was horrific, and you should never get involved in it. I know people who lost money in the financial crisis and dramatically shifted their portfolios into debt and bonds instead of stocks. And when the market recovered, they missed out. I know people who will tell me, we talk to people all the time at Ticker Tape, hey, you should be investing in this pre-IPO deal. And I'm told, hey, I'm never investing in a private deal again because I've lost too much money on those. Don't let that get the best of you. Don't chase trends. Look at long-term investments and long-term title fluctuations. And again, long-term strategy, make consistent pre-IPO investments over time, because you want to have a situation where every year a handful of them are liquidating. So if you make 2 a year and you keep going over time, you'll create a real long-term upside. Last, ignoring management fees. Rule number 5, do not pay management fees. Except for rule number 6, sometimes pay management fees. So this is homage to my father, who I can't even remember how old I was. Don't pay management fees. Don't pay financial advisors. Do it yourself. Learn how to do it. Do it yourself. It's number 1, it's gratifying. Number 2, it can be fun. Number 3, the impact of management fees over your long-term portfolio performance is horrific. And there's all kinds of studies you can look at to see that. Anytime you can avoid it, do it. If you're investing in funds, invest in index funds. Vanguard, I'm a huge fan of. All my parents' money is in Vanguard in low fee index funds because they get the benefit of not having to pay management fees. If you have to have a financial advisor, I'll say it this way: if you're not going to learn, you're not going to take the time to pay attention to your own investments, then I understand. Go try to find a financial advisor, but don't try to. It's not like a lawyer or a doctor where you should find the best lawyer and be happy paying very high fees because you get the best person. Try to minimize what they charge you, because those fees will eat into even the best advisors' performance. So try to stay away from that. Try to do it yourself if at all possible. A couple of examples where even Tom Schmidt and Ticker Tape, well, first of all, please understand Ticker Tape does charge fees on those single purpose entities because there's a lot of work that goes into them. We have to manage the tax returns. We have to go negotiate the deal, do all the legal work for the contracts to purchase the shares. There's a huge amount of work when liquidity comes. So we do charge management fees, but people will pay them, and I pay them myself, because otherwise I don't have an opportunity to get access to that stock. And the best example I give is SpaceX. Not only did I and we pay fees for investing in SpaceX, we paid exorbitant fees because we were paying fees on top of fees. We had one group that found the deal, but they invested in a fund that was already charging fees. And so our investors, we all are paying a fee on top of a fee, which is ridiculous, right? It's absurd. But what was the thing they used to say? I used to work with the guys that manage the Statue of Liberty, and they would say, if you don't like it, go find another statue. There is no other SpaceX, right? So it was a situation where for guys like us that were putting in, I think we put in 4 million total, a little less than that. For guys investing 4 million or less, there's no opportunity to buy SpaceX. So we had to pay a fee that's much higher than we would normally pay because we wanted access to that asset. And we told everybody, guys, these fees are exorbitant. We don't like them. We're only doing it because it's SpaceX. If you don't like it, go find another company that's going to take people to the moon. Same thing with the other example where we're very comfortable with management fees is things like real estate deals, or I mentioned our Ticker Tape Metaverse Fund, where someone is managing the fund. Someone's making ongoing decisions about buying and selling. That's a situation where a higher management fee is justified because somebody's got to be paid to actually do that work. And so we do charge fees. But the lesson from number 5 is ask the question, what am I paying? Understand it. Understand why you're paying that fee. Do I really need to be paying this fee? There's no reason in the world you should be investing in the barren blah, blah, blah growth fund when you can invest in the Vanguard Index Growth Fund and pay 1/10 of the fee to Vanguard that you would be paying to Barron. So think about that. That's my 2 cents on 5 common mistakes investors make. Unfortunately, I have gone long today, probably too many stories about my own history and my father's, but hopefully you guys learned something, and I'm going to let y'all off and everybody go have a good night. In the meantime, in 3 minutes, we'll be back here on GoToWebinar doing an update to the utility rescue investor presentation. If anybody wants to join us for that, you can register for that at the same webpage that you registered for this call. If for some reason you can't get access to the recording of this call and you'd like to, reach out to Rita. Y'all all have her number. It's 832-459-7335, 832-459-7335, and she'll make sure you get the link if you want to go back. I know there's a lot of material, and I tend to talk too fast, but I hope everybody enjoyed it. Thanks for joining us, and we'll see you next time.